Hey guys, it's Sam with Ready, Set, Go. Welcome to the video. Pleasure to have you guys aboard today. Wanted to take this time today to make a quick video on a very important metric for dividend growth investors. And that metric is, wait for it, the dividend payout ratio. Sorry, I'm kind of a nerd. But either way, back to the point here. Before we get into that, though, I do want to make a few quick announcements. If you enjoy these videos, please give me a like, subscribe to my channel. I put a lot of effort into making these videos, and hearing back from you guys and getting a little bit of love is the reason I do it. So, if you have any questions, feedbacks, comment, just want to yell at me for a bit, feel free to leave me a comment or visit my site at www.reddyssetgo.com. And I will be happy to respond to you over there as well. All right, so let's get right into it. The dividend payout ratio, it's probably moving forward, looking forward in the long term horizon. It's probably one of the more important metrics you could look at. It kind of tells you whether a dividend is sustainable. If a company's not earning enough to justify paying their shareholders back a dividend, well, obviously at some point it's not going to make sense. They have to either cut their dividend or that company is just going to go into a loss. So it's when you invest in a fundamentally sound company like you need to as a dividend growth investor, you want to make sure that moving forward revenues, profits, and dividend payouts are all going to be sustainable. They're not going to cut them. They're not going to, then it's going to be worse on your investment, right? So, taken at face value, the dividend payout ratio is essentially a percentage. It's dividends divided by net income. Or, in other words, it's yearly dividends per share divided by earnings per share. And that's going to give you a ratio of, let's say, let's say a company is making $1 and that's their net income and they're paying out 25 cents as their dividend. Well, that's going to be 25 cents over a dollar, giving you 25%. And that ratio, your dividend payout ratio would be 25%. So the reason, it's the reason we want to look at this is when we make these investments, we don't want to take on too much risk. So let's say, you have a company that's paying out a 75% dividend ratio. Well, that means they're only keeping 25% of what they're earning every year. And when you're trying to grow a business, having that 25%, that's the only available capital to reinvest into the business. Well, growth is going to be a lot slower. On the other hand, if you had a company that's only paying out a 20% ratio, that means they're keeping 80% of all their earnings to reinvest back into the business and continue to grow that business moving forward. So you do want to find that nice middle ground. A lot of people say from 25 to 50 is pretty good. Um, that's that's usually the range I look for as well. So let's go ahead and take a quick look here. I brought up Disney. I actually bought them a while back. I wanted to go take a look at them. So in Options House, the brokerage firm I use is Options House. As you can see, I'm in my virtual trading account right now. And essentially, the reason I use Options House, if you guys don't have a brokerage firm or you're in the market looking for one right now, I highly, highly recommend Options House. I will toss a link down at the bottom of the screen over here. You guys can go ahead and click that, or in the description there'll also be a link over to go check it out. The Options House offers a $4.95 per trade, and that's primarily why I use them. And I also really like the research interface. But when you click over to the research tab, there's a little arrow here, and you can go over to the financial section. So once this loads over here, you can scroll down and you'll see that Disney has earnings per share of $4.26. So that means for every available share, they earned $4.26. And at the same time, they offered an annual dividend of 96 cents. So if we bring up our little calculator here, there we go, and we go and take a look, we can do 0.96, because that's the dividend, divided by 4.26, which gives us 0.225. So you take that, multiply that by 100, and you get 22.5%. And so Disney has a dividend ratio of 22.5%. A little bit low. That is, to be honest, that's pretty low. And, that's reflective of their annual yield. It's around 1%, which is, for a company the size of Disney, that's not that much. A lot of people have actually, since I bought them recently, I did a little bit of research. Well, I did a lot of research. But the reason Disney has such a low payout ratio is because they do a lot of share buybacks. And there's a lot of contention with this because when you buy back a share, you're actually driving up demand. There's going to be less available shares, so the price increases. The price per share goes up. So it's not necessarily a bad thing, but the reason, you are getting capital appreciation, so it's not bad. But at the same time, Disney is doing amazingly well right now. They have some iconic brands. Frozen this last summer killed it. It's hard to move the needle though. Killing it with a movie doesn't move the needle that much in terms of revenue or profit for Disney since they have they're a very diverse company. But at the same time, this company is doing extremely well, and a lot of people are asking for a higher dividend yield or payout for their shareholders. But their CEO is still sticking by the initial plan that they've set in place. So, who knows? But you also got to remember, even though it's not an immediate gain right now, the 22.5% dividend payout ratio means that moving forward, Disney has a lot of available capital to reinvest into any ventures that'll help grow revenue down the road. So, in my mind, it seemed like a good point on the last dip to get in. So I went ahead and did it. And now I plan on holding for a really long time and have a lot of faith in Disney. Every one of their movies that comes out, huge fan. So, yeah, that's about it today, guys. Don't want to get into too much depth on this. Wanted to give you a quick way to find that metric in Options House and calculate that for yourself. And if you guys have any questions, always feel free to shout out. I'll be happy to respond to anything. Great. Well, thank you guys for watching. I will catch you later. Peace.